Well, we'll start, though, with the banks. We got B of A, Citi, Wells, and Morgan Stanley to play with today. Of the metrics that are interesting, Jim, MS with investment banking up 67 is going to make it the best of the bunch.
I think that was amazing. And I know we're speaking to James, and I think, once again, it's just a fantastic quarter. But to me, the star of the show was Bank of America because they got expenses flat and they had 12% revenue growth. So they finally got the leverage I've been looking for. They also have very flush consumer numbers that really put the lie to all this negativity that I keep hearing. It comes on our show. I mean, talking about the average American who has $500 to $1,000 having 5 times more net worth than before. 5x net worth. That's incredible.
Than before what?
Even before the pandemic.
Really?
Yeah.
5x.
5x. And then the people who make who have between 5 and 10,000, they're up dramatically too. So what I'm looking at is a picture of America that is much stronger than people realize. We're not a pitiful, helpless giant that a lot of people come on air and say. And I do think if I were Jamie Dimon right now, I would like to take back that credit card comment because his bank is looking like it's the anemic bank, David. Anemic. What is the anemic bank?
J.P. Morgan? And
Yeah.
I answered correctly.
I know. You did. You did.
Yeah.
Right.
Or actually, I gave the correct response.
No,
so.
I screwed up. I should have reversed it. But I would say that this is what J.P. Morgan should actually be up more than be down 4 yesterday. But I am blown away. Citi was great. Wells is a conference call because you never know what Charlie Sharp's going to say is a wild card. But he did buy back more stock than anybody thought he would. But when you look at Bank of America, it's a growth stock. And you look at Morgan Stanley, maybe it's not a bank. Maybe it's a sticky wealth management company that deserves a very different price-earnings multiple.
Although capital markets, like it has been for all of these banks, was very strong for Morgan Stanley, as Wilf reported earlier. I mean, they are particularly weighted towards equities. They had a very strong quarter there. We will speak to James Gorman about that when he joins us a little later in the program. But it's not as though they didn't benefit enormously from that continued wave of activity in capital markets that has now gone on for way longer than many people anticipated. You know, SPACs are incredible. Everybody's doing them, and then they're not. But then something replaces that. And fixed income had been incredibly strong. We still see so many IPOs. Jim, it has been a very good period.
Yes, it has. But what I'm saying is that it's absurd that Morgan Stanley still has a 12 multiple. They're not a bank. They are a wealth advisor that happens to have a lot of good other stuff. M&A. I'm standing by this, David.
I hear you. No, he without a doubt, he has changed the profile of that company over the last 5 to 10 years.
Remember, they used to be episodic and volatile. Now it feels like kind of a just.
Obviously, Buddy traded a great time, as it turned out.
Should it get a Procter & Gamble multiple?
Advance an important deal for them as well.
Should the multiple switch? Procter & Gamble sells 24 times earnings. They're challenged in every single, whether it be supply chain, whether it be raw costs, whether it be what's going on in distribution in supermarkets. They have a 24 multiple. Okay, Morgan Stanley comes along with a consistent positive narrative. They have a 12 multiple. What's wrong with this picture? I think that this shows you that we are paying too much for the classic growth stocks that used to also depend on China being good and plastic being down, and raw costs being down, and distribution being down. And we're not paying enough for these companies that have consistently shot the lights out like Morgan Stanley.